Hello, and welcome to the Three Questions Podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. If you or someone close to you is considering a move from Canada to the US in 2026, you very well might have some tax planning questions. And if that's the case, this episode is definitely for you. What's our topic? The three questions high net worth families should ask about cross-border tax planning when moving to the United States in 2026 or even beyond that. Thank you for taking time to check us out. And if you enjoyed this episode of the Three Questions Podcast, please consider liking this video and subscribing to our podcast and YouTube channels. Joining me once again on the Three Questions Podcast is Stephen Flynn, partner, CPA, and CA with Anderson Tax in Vancouver, British Columbia. Stephen specializes in cross-border tax matters, including investments between Canada and the United States for individuals, businesses, and U.S. citizens residing in Canada. We're exploring the three questions high net worth families should ask about cross-border tax planning when moving to the U.S. in 2026. And Stephen, thank you for making yourself back again on the podcast. Appreciate it very much.
Hey, Wayne, thanks for having me again. We got an interesting topic to talk about today.
Well, we tried to turn the tables this time. Last year we had it for Canadians moving back or Americans moving to Canada, or American residents. This year we're going to go from north to south. Before we get into our three questions, though, let's take a quick look back at last year, 2025, from a cross-border tax planning perspective. What stood out to you as in terms of what was the trend in terms of crime relations, involving treaty applications, or what was there any unexpected challenges that when you look back at last year that kind of jumps to the forefront?
Well, I'm going to focus on your phrase unexpected challenges, because if you go back to November 2024, there was a US election, there was a change to elect President Trump. And January 2025, there was a significant change in how the US was not only treating Canada, but the rest of its trading partners around the world. And you started to talk about tariffs and trade deficits and all sorts of different levels of taxation and costs and charges that had a significant impact on Canadian businesses. And I think it actually had a big impact on high net worth families, because a lot of these families have these kinds of businesses. They're impacted, whether it's themselves, their children, their investments. We found people, made different decisions. They had to, we've seen situations where some businesses decided to move from Canada to the United States, and so the entire business moved across the border. We saw situations where immigration became a bit of a challenge, and so the U.S. changed immigration rules all throughout the year, it seemed. And we had particular situations where clients were planning to move to the United States and didn't have status, weren't U.S. citizens, couldn't get a visa in time, and decided to make very different decisions. And so, when you think about 2025, that's the biggest thing that happened. We'll talk about some other things that happened in 2025, but I'd say when you look back, that's what I think of for the year. We're already in March, and it's still continuing with the Supreme Court decision on tariffs and the implications of that, and then the challenges that face companies trying to seek refunds from that, and also the challenges that the U.S. government and Donald Trump in particular have put on for future transactions.
I really wonder about the tariff refunds. Think that'll be that'll be played out over years, that's for sure. Did you and your team at Anderson Tax have any common observations when you're dealing with families, navigating these complexities? Was there anything specific to Canadian families in particular when it relates to the U.S. and Canada in terms of tax?
Well, I think there was, and I think there was, and something that President Trump had promised in his election in the fall of 2024 was tax reform. And he and the Republicans in the House, the Senate, and the Congress delivered on that in July 2025 with something called the One Big Beautiful Bill Act. And it had a number of changes for high net worth families. In particular, what the act did is it solidified and got some clarity on something called the lifetime gift and estate tax limit. And so the concept of death taxes or taxes on one's death in the U.S. is very different in the U.S. compared to Canada. Canada, we tend to tax, unrealized income or capital gains at death. We give some delays for one spouse that transfers assets to the surviving spouse. The U.S. concept's very different. It's a tax on value, not a tax on gains, and it has an exemption. And so that exemption amount has, over kind of my 2, 3 decades of doing this, if I think about when I started getting specifically into this area, when I first started, the exemption was $1 million. It increased to a few $1 million. It got to zero in 2010. There was no death tax for 1 year, and then it reset again. And so it's kind of been all over the map. In 2017, when Trump was first elected, that exemption was raised as high as 15 million, but it had a sunset to it that it had to expire. And so, without any changes, that estate tax exemption was going to reset from wherever it was at 12, 13, 14 million last couple of years. It's going to reset to about half that. The One Big Beautiful Bill Act put a certainty on it and said it's $15 million per person. And, for a lot of Canadian families or a lot, that have U.S. assets, whether they have U.S. real property interests or U.S. securities or U.S. trade or businesses, that comes as welcome relief because now they've got some certainty. And for a lot of families, because it's 15 million per person, it's 30 million per family, it's 30 million US. US estate taxes may not be as much of an issue, but at least there's some certainty there. So that was, I think, one of the big things. There were some other things in the One Big Beautiful Bill Act, particularly for entrepreneurs in the tech space, but it could be any entrepreneur. The US has something called the Qualified Small Business Stock Rules that, unlike Canada, are kind of much more attractive when it comes to the amount of gain that could be tax free and the ways you can multiply that. And so what happened in 2015, those limits went up, and now it's the first $15 million of the gain can be tax free. The amount of assets a company has to qualify for qual business stock goes up to about 75 million. And there's some interim amounts because it originally was you had to hold the stock for 5 years to qualify. Now you can hold the stock for 3 years and have a partial qualification. So it got a lot more attractive. And we've seen quite a few. We'll talk a bit about this. We've seen a lot of entrepreneurs that have kind of looked at Canada, looked at the U.S. and said, lots of more favorable tax regime in the U.S. So, that was probably the biggest thing. I think the last thing for high net worth families, particularly in the international tax space, is the U.S. has something called the Global Intangible Low Taxed Income, or GILTI for short. And this is an acronym that's been around kind of 7, 8 years. And the idea is that if you're a U.S. citizen and you have a controlling interest in a non-U.S. corporation, that you can't just defer tax within the U.S., within that foreign corporation. If that corporation makes money, then you personally, as a U.S. citizen, would be taxed on some amount that gets flowed to you. And there's a disconnect sometimes between what the company makes and what you should be taxed personally. And if you don't kind of, manage that properly, you can have an element of double taxation. And effectively, the way the rates and the deductions went, that effective tax rate goes from about 10% to about 14% over time. So GILTI is a little bit more of an issue because it's more of a rate. There are solutions for that, but these are some of the things we saw in 2026.
Well, I guess the only one I can come up with and is just as an aside that was, I mean, for some people, I think it was kind of a big deal, was the elimination of the windfall elimination provision. I was on Social Security Canada pension plan. It used to be that up until the beginning of 2025, there was when Canadians were getting, they had their Canada pension plan, old age security on top of their Social Security would be reduced. There was a factor related to how much, how long they lived in the United States, how many years they worked in the United States and collected Social Security or accumulated Social Security. And depending on how long they were in the U.S., depending on how much they earned, they would have their Social Security clawed back as in relation to what they earn in CPP and OAS. And that was eliminated beginning. This is after the Trump administration came into power. They basically eliminated it. And some clients of mine actually got checks at the beginning of last year. And they were almost afraid. They were contacting me because they were wondering if it was safe to cash them.
Is this real?
Is this exactly? I have multiple clients contact me and say, I got this check from the U.S. They're saying I get like $6,000, right? And all of a sudden they notice their Social Security payments are larger. And I said, no, this is they got rid of the WEP. So that's one I had. I don't know if it's so much maybe tax per se, but kind of was withholding. It was
I
a
think all those are related. I mean, one of the things, and we can talk a bit about some of the trends we see, but you know, I think Social Security is a tax. Yes, it's great to collect those checks, if you will, but you paid into it when during your working life. And we often talk to people who move from Canada to the United States to say, okay, if your view of this is a tax, is not an investment, because your rate of return on paying either Canada pension premiums or U.S. Social Security, your rate of return is fairly low when you look at how much you put in. There are ways under the U.S. Canada Social Security Agreement, depending on when you move to the U.S., if it's temporary, if it's with a related company, that you can avoid paying U.S. Social Security and Medicare and continue to be Canada pension plan. That could save people tens of thousands of dollars a year. You got to have a unique set of facts and a unique arrangement, but a lot of our clients can fit that. And yes, down the road, you wouldn't collect Social Security because you haven't paid into it. But if you just take the savings and invest the difference, my guess is you'd be much farther ahead.
well, especially going forward, because one of the things that we're factoring in for a lot of our clients at beginning, say 2030, I think it's 2035, 2034, 2035, we're not in our capital forecast, we're not factoring in any COLA adjustments from that point
Mm.
going forward. So let's say if you're expected to earn $40,000 a year in Social Security payments as of that year, in our capital forecasting, we show that number not appreciating beyond that point, it stays the same. So it's a
Well,
fact.
that becomes a real challenge over 20 years when you think of
Yes, well,
inflation.
exactly right. Because that 40,000, it could become 30,000 in
Sure.
purchasing power, right?
Yep,
All right, well,
absolutely.
Stephen, thanks for the context here. Well, again, we got a lot to cover here today. So let's get to the three questions high net worth families should be asking about cross-border tax planning when moving to the US. And let's get right to the first question. Question number one. I am a Canadian business owner. My children are involved as owners and beneficiaries of the business, and they're attending university in the United States. In addition to the business, I also have RRSPs, non-registered accounts, and TFSA accounts. What cross-border tax planning strategy should I be considering for 2026?
So it's a wide-ranging question, and I'm going to focus first on one of the factors in there, which is it's a Canadian family. We're going to assume that they're not U.S. citizens, they're not U.S. green card holders, but the children are attending university in the
I'll be
United
on what's
States.
called
And
an
so,
F1 visa. I think what they call
abs-
it.
exactly what it is. Our daughter played soccer in the United States. She was on an F1 visa for 3 years when before she graduated there. And I got to learn a lot of these nuances and rules that apply. And so there's a couple things here. One, from a US perspective, and I'm glad you said that, Wayne, because an F1 visa is unique status because it covers, in general, your studies. You have a limited ability to work in the United States. You can either work on campus or you can work in your field, and it's kind of limited to your program. From a tax perspective, for the first 4 years that you're in the United States on an F1 visa, the days that you're present in the United States don't count towards residency. And that's a really important point because under US law, it's a little different determining residency than Canada. Canada is very subjective. We look at all your ties, we look at where your job and your family and everything else is. The US is much more objective, and it says, you know,
More
let's count the number of
quantitative
days.
versus qualitative, right?
Absolutely. And there's something called the substantial presence test that it's a weighted average that says take the days in the calendar year, take 1/3 of the days in the prior calendar year, and take 1/6 of the days in the second prior year of any reason you're in the United States, whether it's for work, for school, for shopping, going to a Mariners game, like you name it, and add up that formula. And if it's 183 days or more, then under the substantial presence test, you're a resident of the United States. Now, you may also still be a resident of Canada, and this is where the Canada-US income tax treaty can come in and break the tie. But if you're just looking at US rules, a student going to school in the US, if they're going to be down there for 4 years, and let's say kind of that's August to May type timeframe, they're going to blow away the substantial presence test, except for the fact that those days while they're on the F1 visa do not count. So they really don't meet the substantial presence test. But in order to confirm that and assert that, what some families should do is consider whether they should file a specific IRS form. It's called IRS Form 8843. It's not a tax return, it's an information form. And it basically asserts to the IRS that yes, you were in the US for all these days, but because you're under an F1 visa, these days don't count for purposes of determining the substantial presence test. And the reason you might file that is in that question you asked, if the children are beneficiaries of a Canadian trust or if they're shareholders of a Canadian corporation, absent filing that form, if the individuals were or did meet the substantial presence test, then yes, you could still use the Canada-U.S. treaty to get them out of paying taxes. Likely they're still residents of Canada because they're of the way the treaty works. But the U.S. under U.S. tax law, they'd still have to file tax returns, and they'd have to
Mm.
file information returns on the trust and on
You
the
start filing tax
corporations.
returns, that opens up a whole can of worms.
Well, these returns, if it's multiple corporations or a couple family trusts, they could be a page thick, and they could have significant penalties for failure to timely file. And the way to get out of that obligation is just to go to the IRS and say, hey, these days don't count because of the F1 visa. So we filed that on occasion for some families whose kids are in the U.S. For other whose kids are in the U.S., if they don't aren't a member of the aren't a beneficiary family trust and aren't a share of the corporation, if all they've done is maybe they had a job on campus in the bookstore and they made $5,000 and they got a W-2 with $100 withheld. If that's all there is, I'm not sure I'd bother filing anything because yeah, they may have a social security number and they may have $100 they paid and could get back, but by the time you go through the pain of filing the tax return and doing everything else, it's probably not worth it to get the $100 back, and you probably don't have to file anyways. It's only if you've got these other connections that would require you to file, would you consider filing this information form? So from a U.S. perspective, that's one of the things. From a Canadian perspective, it's a little bit more interesting because what Canada will allow students to do if they're still resident of Canada is to claim tuition and claim books and claim fees as tuition credits in Canada, whether you paid it or whether you were on a scholarship and the school paid it for you. And there's some steps you have to do from a Canadian perspective. You got to get a form filled out. You got to work with the university's admissions office or their finance office and figure out what counts and what doesn't count. But if it works, and we did something years ago for a young man who was on a full ride scholarship to an Ivy League school, and I'll bet you the total tuition was $300,000
You're
over
going to
four
say that's a
years.
$200,000 falling out of bed
Absolutely,
easy.
absolutely.
250.
And he thought in about 5, 7 years he'd come to work in Canada. I said, well, let's at least claim those credits, even though you didn't pay them. There's a way that it's effectively not taxable in Canada, but it is a credit that carries forward. And so those credits don't expire. And so if he ever comes back to Canada and works, he's got $300,000 of credits sitting there, and at 21%, so that's worth $63,000. So it's something to think about whether you paid the tuition or you paid part of the tuition or there was a scholarship involved. It's worth doing that math for your students. So that's kind of the first piece of that for families to think about.
So anything we're missing here? Is just any considerations that we didn't? I think you covered a couple really good ones there. The one I was thinking about is that the importance of the reporting that you talked about. And again, I talk about this all the time with my peers, CPAs, estate planning attorneys, whatever the case. The do-it-yourselfer, the things well, and when you were chatting there, I must admit I was thinking to myself, there's as much that can go wrong because of omission as there is commission, right? In other words,
Mhm.
is I didn't know I was supposed to do that versus, well, I did something I shouldn't. You know what I mean? Like, so is there anything else that you would suggest that people consider if with the idea of their children decide to remain? This is what I'm going to put a caveat. They decide to
Well, is
remain
it?
in the US. They say,
Yeah,
you know what,
isn't that what
Dad, you know what,
happens?
Mom, I got a job offer here. I just can't refuse. Well, how does that change the narrative?
Absolutely. I mean, it's a good segue because what's going to happen there when they graduate, they're going to change their visa status. So they won't be on an F1 visa anymore. They'll be on something else, an O1, a J, whatever the terms are, TN, whatever it is. They will be on a different category. And now under US federal tax law, now those days count towards residency. And so you can no longer claim an exemption generally. Now, if you meet the substantial presence test, you probably would be a resident of the US under that days test. And more importantly, as you just described, if they've got a job down in the US, they probably have an apartment down in the US, or they've bought a condo down in the US, and their lives are in the US, and they bring the car down to the US, and they set up bank accounts, and they're spending 300 days in the US. They may come up for a month in the summer to go to the cabin, but their lives are now in the United States. So when you look at the Canada US income tax treaty and you look at all the treaty provisions that discuss residency, they're going to be US residents. And so there's some big implications there. So the first one from a US perspective is now they're taxable in the US on their worldwide income and their worldwide assets. And so if you take that same family where the young man or woman graduated, they got a job in the United States, they were a beneficiary of the family trust, they were a shareholder in the Canadian corporations. Now those activities are now subject to US taxation, US reporting requirements. And without kind of the proper analysis of what that means, you can end up in a couple situations. One, you can end up in a situation of double taxation, depending on what the type of asset is. Two, you could have, a whole bunch of other reporting requirements, again, depending on the beneficial interest, depending on the ownership of the assets that you may not be aware of. And the US is very good at significant penalties for failing to report on a timely basis international assets, international, shares you have in an international company, shares you have in a non-US trust. And so those are the things that really change once they become graduates and now they move to the United States.
And the penalties for failing to report those foreign assets can be rather intense, for lack of a better
Well,
word.
they can. For a corporation, it could be starting at about $10,000 a year for each corporation you have. It could be higher than that. For a trust, those can be even more egregious and higher. It can really depend. It really depends on how the trust was set up, whether it's a discretionary trust, whether you put funds in the trust. There's a lot of factors in there that's probably hard to cover on a podcast, but these are the things families have to start thinking of to say, okay, all that planning that we did, we maybe did an estate freeze, we set up a family trust, we've got the common shares in the trust from Canada, we've got everything, we got all this great plan. Now we have to think about the fact that the children are U.S. persons, U.S. residents. Now, what does that mean? And what are some of the strategies to help with that? And there are, they're not fatal. It's just, the more that can be done in advance of knowing this, the more we can help identify and address and propose some strategies.
Our topic this week on the Three Questions podcast is the three questions high net worth families should ask about cross-border tax planning when moving to the United States in 2026. Joining me from Vancouver, British Columbia is Stephen Flynn. Stephen is a partner in CPA and CA with Anderson Tax. Stephen's work focuses on cross-border tax matters, including investments between Canada and the United States by both individuals and businesses and U.S. citizens residing in Canada. Stephen, let's get on to question number 2. My spouse and I want to join our children who are now living in the U.S. What are the main Canadian and U.S. tax consequences of moving to the U.S.? Stephen, over to you.
Sure. And similar to what would have happened to the children when they graduated from university, changed their visa, became U.S. residents, from a Canadian perspective, whether it's the kids that graduated first or whether it's the mom and dad that followed later, from a Canadian perspective, they've ceased residency in Canada. And, Canada's got a, very different way of taxing that compared to the United States. We tax based on residency. We don't tax based on citizenship. So when you leave us, when you move from Canada, that is Canada's last chance to tax you on your worldwide income and your worldwide assets. So we have a concept of what's called a departure tax. So certain assets are deemed to have been disposed for their fair market value as if you sold them day you cease to be a Canadian resident. And again, not necessarily a fatal result. It is just simply something that happens. There are strategies to minimize that, to delay that taxation. It doesn't apply to every asset you have. It wouldn't apply to Canadian real estate that you own personally, for example. That can be taxed later. There's mechanisms to do that. It wouldn't apply to your pension plans in Canada, like your RSP or a RIF. Again, those are subject to tax under the normal course. But it does apply to private company shares. It applies potentially to that family trust, depending how you've set it up. That can be avoided in certain circumstances. It can apply to your investment portfolio in a non-registered account. And to the extent you've got significant unrealized gains in any of those assets, Canada would say to you, well, you've left, we're going to calculate a capital gains tax on that. And we expect when you file your tax return next spring that you're going to pay that tax. And that catches families a little bit because oftentimes these assets are not liquid. It could be shares in a family business. It could be a portfolio that you don't plan on selling anytime soon. It could be all sorts of things. There are strategies and plans that Canadian government has to say, okay, well, if you don't want to pay the tax, you can provide security, and it can come in a multiple different forms. We'll get the tax someday, but as long as you give us, security that allows us not to have to chase you all over the globe, then you can delay that taxation. So there are ways to do this, but it is something that families have to face because that's Canada's last chance. And so it's one thing for the children to move, and maybe their assets, especially when you're 23, 25 years old, you don't have a lot of assets, you don't have a lot of gains and things. Maybe, those shares in the family company, but oftentimes, that may not be much, but it's the parents moving that can have a significant impact there.
Okay, so for Canadian residents that are becoming U.S. tax residents, how can they mitigate? Is there a strategy? Is there one? You talked about the security. Maybe you could talk a little bit about that.
Sure.
I also want to talk about, I can't avoid this, is explaining to Canadians, just as an aside, a lot of Canadians have taken advantage since 2009 of the tax-free savings account. The great strategy, especially for younger families, but even people more advanced. Great way of sheltering some money in a tax-free strategy. Money can accumulate tax-free. It's with after-tax dollars. You don't have to pay any income tax on the capital gains when you take it out. You don't have to pay income tax on it. You can put the money back in the next year. It's all good. Then you become a U.S. tax resident. So maybe you could talk about a little bit
Absolutely.
on this on the exit tax, but also chime in on the TFSA as well. I appreciate that.
Sure. Let's reverse them. So I'll talk about the tax-free savings account. So that, from a Canadian tax perspective, that can remain tax-free from a Canadian perspective. You can't put any more money in once you leave.
Same as
Putting more money into the account can lead to fines and penalties, and it's not worth your while. Uh, it's not tax-free from a U.S. perspective. The Canada-U.S. Income Tax Treaty, at some point, if they ever do make changes, I would expect that to be something that would be rolled into a future tax treaty revision because the dollars are never big enough to worry about. And there's also a precedent for this because the reverse, what's called a Roth IRA in the US, if you're a American resident and you had a Roth IRA and you moved to Canada, if you meet certain criteria, it can be tax-free in Canada. So that concept's there. But right now, tax-free savings accounts came into existence after the treaty was last negotiated in 2007. We're almost 20 years since we've changed the treaty. So they're taxable in the US. And so it's not as great of a benefit anymore because it's taxable. And what we often see is not only is it taxable in the US, but a lot of people will put Canadian mutual funds, exchange traded funds, index funds inside of a tax-free savings account. Not an issue for Canadian purposes because they were tax-free, but the US treats these very differently. Any non-US corporation that has more than half of its assets invested in passive activities, which is pretty much most index funds or exchange traded funds or mutual funds that are organized in Canada, those are something called passive foreign investment companies. And there's a lot of abbreviations and jargon and
PFIX,
math, but
passive
PFIX, if
foreign,
you will,
yeah, that's the one
PFIX
we use
aren't
then.
necessary. They're not necessarily great in the US. There's a high rate of taxation. There's a bunch of reporting requirements. There's an interest charge if we hold it long
And
enough.
there's the fees of reporting, the fees of
Sure,
CP. Yeah,
there's
okay.
elections you can make to get out of it, but you got to ask yourself, is it worthwhile to do that, or
Just
you
move the money
know,
over to into your revocable trust in the United States would probably make more sense.
well, Wayne, you've seen this in your business too. I mean, you guys have strategies that would say, hey, we can actually do something very different from mutual funds in Canada, and at One Capital, you can hold them very differently, so you don't have this problem. And
Well,
so that's often what we tell people is to say when you talk to Wayne and his team that he'll have different investment direction for you that will hopefully avoid some of this.
one of the great things that we've done here, and this is applicable for Canadians that are moving to the US, and it's applicable for non-registered accounts, Canadian dollar non-registered accounts, and also I'll add to that TFSAs, and this is in the case of the US resident, is that we have, and I don't know of any other financial institution in the United States that can do this, but we can bring those Canadian dollars across the border
Hmm.
and not convert them to USD. So
Okay.
Canadian dollar is 73 cents. Who wants to convert Canadian dollars to US dollars today? Not really the best time from a foreign exchange perspective. So we can bring those dollars across the border, and we've designed models that are very what we'll call PFIC friendly for the client, so that their amount of reporting on PFICs is very limited, maybe two for the year if they do it correctly. They get fully diversified portfolios. Our best ideas at One Capital Management for both equities and fixed income, fully diversified, no conversion to USD. So that's a strategy I use with a lot of my clients to this day. So that's one approach. But again, the idea of it's a foreign exchange for a lot of Canadians. A lot of times they get themselves into trouble is the first thing they look at, and this is very common, is they look at the foreign exchange and they go, I'm not converting my dollars at 72 cents or whatever it's at, and they leave the money in. One of the common mistakes we see is people leave their money in Canada. They'll just say the heck with it, and they're not aware of the F bars, for example, or they're not aware that I got left the money in Canada, I've got it in 15 mutual funds. Well, yeah, you got a PFIC problem and an F bar problem, right? So
As you said, there's better solutions for that, and it's good to hear.
yeah.
Your other question was an interesting one, which was how do you handle the fact that Canada has
The exit
partial tax
tax,
control? Yeah,
yes.
sure.
Ooh.
So the nice thing Canada's had in this legislation and its rules is the ability to, if you provide security, and we'll go through some of the examples, that not only do you not have to pay the tax now, you can defer that tax until such time as you sell the asset. And the nice thing about the deferral is there is no interest charged on the deferral of that tax. And so you can imagine in situations where you've moved to the US 20 or 30 years ago and you had a business, you had an asset, and you deferred the tax on it. A deferral of tax for 20 or 30 years at no interest is basically like saving the tax because you take that money you would have spent and you invest it and you've already made it back. And so that's an important strategy. There's a couple ways to do that. And it depends on the asset. If you have a controlling interest, for example, in a Canadian corporation, it's a business or it's an investment, corporation, whatever it is, you can pledge those shares as security to Canada. They'll take a secured interest charge based on the province you come from. They will monitor that. You'll get letters every year saying, did you take any dividends out? Did you sell any shares? You can still take dividends out of those corporations. You'll pay tax on that as if you sold a portion of the shares as a capital gain. So there is tax to pay when you take it out, but you have the ability to you can still pay salaries to yourself. Like there are ways to take funds out. You just have to maintain an appropriate ratio of assets to the tax. And so as long as you cover that, you can pledge the shares. There's some work to do to pledge those shares to get the secured interest. The other way to do it would be to get a letter of credit or a letter of guarantee from a Canadian bank. That has some requirements, though. You need to leave funds in Canada with a Canadian chartered bank. Those funds are effectively frozen. A bank's not going to take any risk there. If you've got $1 million liability and you want to get a letter of credit or a letter of guarantee for $1 million, you got to put up $1 million and a little bit more in that fund. And you probably don't have a lot of easy ways to do risk-free, risky trading because the bank's not going to take any risk. And for that privilege, you'll probably pay a fee of 1 to 2% a year, the face value. So every year you're paying on $1 million, you're paying $10,000 or $20,000 to have that letter. So that's another way to do it. If you get real
Does it
estate in
work? Does
Canada,
it work for liquid assets too, or is this only working for privately held businesses?
well, the security generally has to match the asset. And so it would be hard, for example, to pledge. I don't think you'd be able to pledge shares in a private company to offset gains on some other asset. You can often use, for example, if you've got real estate in Canada and you've got a low mortgage and there's enough room to put a secured, like a second charge on it, you can do that against the asset, and then your cost is just the cost of the security. It would prevent you from selling the asset because once you sell the asset, now you got to replace the security, which you can do. Uh, the other way is some people look at it and say, hey, the dollars just aren't worth it. I'm going to pay the tax. And when you move to the United States, there's a mechanism under the Canada-US tax treaty that says, okay, if you're moving to the United States and whether you're a US citizen or not, or depending on the situation, if it made some sense, you can make an election under the Canada-US tax treaty to say, okay, I got this gain in Canada. I'm going to pay some tax in Canada, but when I go to the United States, I want to make this election to say, whatever the value of the asset is, I want that to be my new cost basis for US federal tax purposes. because I don't want to pay tax twice. I don't want to pay tax when I leave Canada, and I want to pay tax 10 years later on the same asset for federal tax purposes. And so that's an effective election. The caution you have, and you'll hear this from time to time, is each state in the United States is different. Not every
That's
state
right.
follows the Canada Tax Treaty. And I'm looking at you, Wayne, in beautiful sunny
California.
California. California doesn't follow the Canada-U.S. Income Tax Treaty. California wouldn't care if you make this election because it's not effective for state income tax purposes. So, there are other ways to handle that from a California tax perspective, depending on the asset, depending on what you do. There's some case law in California that actually affirms some of these strategies will effectively increase the cost basis for state tax purposes. So there are ways to do it. It really just depends on the asset, depends on the structure you put in place.
Stephen, I want to move along here. I know you're on a bit of a hard
Absolutely.
stop, so let's move on to question number 3. We are planning to relocate our family to the United States before the end of the year. I plan on maintaining my Canadian business operations. What strategies can we use to avoid double taxation on income? Take it away.
And that's a wide-ranging question. And what you have
You
to focus
you
on
can
is
provide the Coles Notes version for today's podcast if you're limited here on time.
the 5-minute version is something we talked about before, which is under US tax law, there's something called the Global Intangible Low Taxed Income or GILTI rules. And typically, when families move to the United States with an active Canadian business, they've got a controlling interest. The two spouses own 100% of the shares, or they've got a controlling interest. So it's going to be what's called a controlled foreign corporation for US tax purposes. As a result, the GILTI tax rules apply. And so now you got this situation where you make a bunch of money in Canada, you get Canadian corporate tax you're paying on those profits, but at the same time, under US federal and most often state tax law, you're also taxed on those profits for personal federal and state tax purposes in the US, even though the profits are still in a Canadian corporation. And so it's not easy to kind of use the Canadian corporate tax to offset your US personal tax, but there's a number of strategies to handle this. And it could be everything from paying salaries out to yourself if you use the money and use the money each year. That's a way to break the company even, so there is no GILTI, because GILTI is only applicable if there's taxable income in the company. That's one way to do it. Another way is if the Canadian corporate tax is more than 90% of the effective US corporate tax rate, you get this high tax exception. And so for some families that move from Canada to the United States, all of a sudden the corporate tax rate on the income in the corporation isn't that low small business tax rate we have, because it's not a Canadian controlled foreign corporation anymore, a Canadian controlled private corporation anymore. Now the tax rates could be 25 to 27%. That might get you out of it as well. The other really unique one is a very particular election you make under a particular code section in the United States. It's called 962. It treats that corporation and your interest as if you yourself as a corporation. It's hard to get into the mechanics, but you can effectively use deductions and foreign tax credits to try and alleviate. So it's like for us, that's one of the biggest things you do. If you come to us before you move, and depending on the type of assets in that corporation, you don't have to have it as a regular Canadian corporation. You might be able to convert it to something called an unlimited liability company. And that's a Canadian concept that's in a couple of provinces here, but you can extend that across the country. And you'd say, well, why on earth would you do that? Well, from a US perspective, an unlimited liability company is very different. It's not going to be subject to these GILTI rules and these controlled foreign corporation rules, because it's more like what you see in the United States. It's a disregarded entity. It's a flow through. And when people go to the United States and look at what all their neighbors are doing for businesses, they do it very differently in the United States. They have limited liability companies. They have
Yep.
S corporations. They basically, from a tax perspective, all the
They're
income
just
is taxed
flow
as flow
through. All the income flows through to the
through.
yeah.
And an unlimited liability company can be the same thing, because the income, the expenses, and most importantly, the Canadian corporate tax that's paid all flows onto your personal tax return. So that's a very complex planning technique. We've done it before with lots of families. That can make some sense. You got to go through the legal aspects of it, because it is just that, it's unlimited liability, but it can work really effectively to avoid some of these anti-deferral rules in the United States.
So if the family has significant real estate holdings, is it possible to structure ownership in that case to minimize a state tax exposure, so that they got real estate, hard assets, not liquid assets, not the business. They got real issue is that you once you become a U.S. taxpayer, you got the estate tax risk all of a sudden. So, is there anything we can do about that other than selling the properties and bringing the cash to the U.S.? But no, you say I want to keep my real estate in Canada. How do we structure that to
Yeah.
other than
Well,
buying a
look,
big old life insurance policy to offset the tax bill?
yeah, I think the first step is to step back and say, well, what exactly is this? And so once you become a U.S. resident, and more importantly, from an estate tax perspective, you're a domicile of the United States. Now you're going to be subject, if you pass away in the United States as a domicile, you're subject to U.S. federal estate tax on your worldwide income. And that goes back to what we talked about, that if your net worth is under 15 million per person, you're not so worried about it. But if your net
Hmm.
worth is high, now your
Or
worldwide
projected to be
assets are
high, or
subject to
even
this.
projected in the future to be high.
Sure. Well, and as much as inflation is going to increase that 15 million, your hope is your net worth grows past that. So people that may not be subject to it now might say, well, in 20, 30 years, I may be subject to this. And we don't know what
Exactly.
the administration is going to do to change it. So now you look and say, okay, well, my net worth is subject to this estate tax. And now, what are some things you can do, regarding it? And we've seen everything from, the use of trusts, and you have to be very careful because there's dispositions with trusts, but if you can structure it in such a way that maybe you don't own the entire asset anymore, that your family owns it and the growth is with the family, that could be a way of getting the growth in those real estate assets out of your hands for estate tax purposes and maybe in someone else's hands. So there's things you can do there. I've seen families take on life insurance policies. I think that can make sense if the premiums make sense. The tough part with life insurance when you're using it for estate tax purposes is as you get older, those premiums become far more expensive. And now you start to look and say, well, is that the right solution? When if you looked at trusts or loans or other things within those assets, that'd be another way to do it. There's a whole host of U.S. solutions for that we often see. And they can be charitable remainder trusts. They can be all sorts of different trusts that can handle those things as well. What families should be doing is not just looking at what is it today, but what's the 20, 30-year horizon? Because then you start to say, well, what are the gifts I can make now, or what are the transactions I could do now that if I project this over 20, 30 years, that growth is in someone else's hands, and maybe I still have access to the income from it. There's ways to handle those types of things. Hard to answer in this podcast, but that's what you'd be looking for.
Stephen, we get wrapping up here.
Sure.
I just can't help but think about the family that's just starting out. They're like thinking myself back 13 years ago, 13 and a half years ago, just thinking about idea of moving to the US. What's one piece of advice you would give to them on as far as from a cross-border tax planning perspective as they're thinking about moving to the US? What would be the first thing you would say to them?
Well, it's of self-interest, but I would say this for any family. It's getting proper accounting, tax, and legal advice and getting it far enough advance of the move to give
Time is your
yourself
friend.
time.
Make it your friend. Make time your
Absolutely.
friend. Yeah.
And how much is that time? I mean, 6 months to a year often, if you really know that, because if you've got a complex set of, corporations, trusts, investment portfolio, whatever it is, it could take 6 months to a year to get yourself structured and to do the things you need to do before you move. If it's within a series of weeks, you're going to have a tough time pulling the trigger on any complex plan to do so. The more time you have, the better the plans are going to be. And it's advice, and it's tax advice, it's legal advice, it's you're looking at your wills, like everything
Yeah,
you
you
do in
just took the
Canada,
words
for
out of my
example,
mouth.
it's
You got
it's now you're going to a different jurisdiction, and so the things we did to avoid tax and probate and everything else in Canada, they don't those plans don't work when you're in California. It's a very different set of rules and a very different set of strategies, and it's getting that advice and thinking that through as you make that transition.
Yeah, I agree with you 100%. Just one last thing. Any sort of emerging trends or issues from the cross-border tax planning perspective that have got your attention for this year? Anything that people should be thinking about? And we talked about what we saw last year. Anything for 2026 that people should be thinking about?
I gotta say, it's probably it goes back to COVID. So you're 6 years now. It's the mobility of families and generations that uh, You just see it far more now where, families aren't necessarily anchored in one jurisdiction or one country. And, generations will often follow other generations. And so, that mobility and that lifestyle, it can move around tax residency. People have to understand that you can still spend time in different jurisdictions. You don't have to be a resident of the other country. And, that decision, whether you do or don't, should be driven by everything from legal to tax to healthcare coverage to, there's a whole host of things you should be thinking about. Tax is definitely one of them. Uh, that's what we see. I mean, we see some southbound activity, I think, from young entrepreneurs that look at the US and say, I need to be there to grow my company. In contrast, we see a lot of people that are perhaps, finished their career and looking around and seeing the grandchildren, the children in Canada, or even, Wayne, just seeing the political environment in the US and saying, I don't want to live here anymore. And they move to Canada. And it's we're just seeing a lot of migration going both ways, you know, probably since COVID, but even before that. But in the last few years, I just see more and more, and we expect it to continue.
So for those who are watching us here, we put your contact information right underneath you on the screen so everybody can see
Excellent.
your name, company, phone numbers, email addresses, all that. But we got a lot of people who are listening on Spotify, on Apple Podcasts, driving around in their car out for walks, whatever the case may be. What is the best way for them to contact you? They've been listening to today's, but oh my God, I got to talk to this guy. So how can they contact you?
Best is through email, and my email I think is on the screen, but I'll repeat it in case you're driving or you're listening. It is Stephen.Flynn at ca.anderson.com. Anderson is spelled with all E's, and an email's best. I'm happy to always, spend a little bit of time with people, no fee, no obligation. Let's listen to your situation. Let me see if Anderson can help you. If we can talk a bit about what it involves, what's the scope, what's the fees. If we're not the right firm, I might be able to make other recommendations to you, but we're always happy to meet people and meet clients in these, unique situations. It's something I've done. It's going on 30 years now, and it's something I really enjoyed helping families with. So.
Stephen, I want to thank you so much. I know this is like, again, the busiest time of the year, March, spring. This is when CPAs are like, they're in the trenches. So I want to thank you for making time for us today.
Absolutely.
Really appreciate it. Stephen Flynn joined us from Vancouver, British Columbia. Again, he's a partner, CPA, and a CA at Anderson. Thank you, Stephen. We'll see you soon.
Thank you, Wayne.
I look forward to bringing you the Three Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification of when our latest episode has been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we will see you soon.